Hello, everybody, and welcome to our virtual tax school webinar today on maximizing tax deductions in a 1040 tax return, a topic that consolidates a lot of the maximizing tax deductions webinars that we've hosted in the past. So a little bit of Schedule C, A, and E, and who better to cover those topics than our own Anthony Sampson, enroll agent and solution architect for Wolters Kluwer Tax and Accounting. And Anthony, I'm going to let you introduce yourself as you are our primary speaker for today. We're very excited that you are here and that you're presenting on this topic in particular, which is one that has been heavily requested in years past. So I'll let you take it over from here, Anthony.
Absolutely, Luis. I'm so grateful to be here. My name is Anthony Sampson. I'm a practicing EA. In addition to that, I'm also a solution architect here at Wolters Kluwer. And solution architect is a fancy title, a very nice title for someone who actually spends time with the customers, our tax customers, spends time with the tax office, specializing with it, getting a good understanding of the product, and someone who has industry experience. So I've got a degree in accounting, and also, as I said before, over 10 years as a tax accounting professional. So we've got a lot to cover here today in our presentation. And a couple of things, let's go ahead and talk about our objectives that we're going to cover here today. So we're going to walk through and talk about how to understand some 1040 deductions when it comes to either a Schedule A, C, and E, right? Understanding what's legally deduction that we can take and how can we maximize those actual deductions. Let me adjust that on my webcam there. All right, perfect. Identify the differences between the mileage and actual expense deduction. That's something that always comes up when you've got clients that are self-employed. Are they keeping track of their miles and things of that nature? Which is the most advantageous? So we're going to spend some time talking about that. In addition to that, we're going to explore the differences between the simplified method versus the actual expense method, right? When it comes to using the home office deduction, we're going to make sure we spend some time on that. And then also recognizing the opportunities to use travel expenses when clients have a rental business, right? When they have that rental property. I'm just curious, so show of hands. Well, of course, can't do a show of hands, but I'm just curious, how many of you got rental properties? Typically, clients that have rental properties or have a business, they're more likely to engage a tax professional because it gets a little bit more complicated, it gets a little bit more challenging. So we're going to talk about ways to maximize the deductions related to those types of businesses and learn how to determine if a client is materially participating in a business, a rental business at that, and then also to what the active participation is, rules around that. So we got a lot to cover today. We're going to use some of our examples, some practical 1040 examples we'll be using in TaxWise. But today we're going to walk through this part of our segment. We're going to go ahead and walk through, and I'm going to go ahead and time myself because I want to make sure that I don't go over time here. So I got my little timer right here. I want to make sure that I be respectful of everyone's time. All right, so we're going to start off with talking about the actual Schedule A, right? Schedule A 1040. And we're going to talk about some of the mileage deduction, not the mileage, excuse me, the medical deductions that could be overlooked. And when should we force itemized deductions? That's a big topic. And maximizing charitable contribution deductions, right? Now, I want to make sure I preface this. This presentation was really birthed out of an experience I had. So when I first started out being a tax practitioner, 10 plus years ago, I was at Jackson Hewitt, right? I was still in college and I was working Jackson Hewitt during the summertime. My wife recommended I go work at Jackson Hewitt. And I think I was in my second season, busy season, tax season. And this client came in, very nice lady. She had all her deductions. She was organized, went through the interview. She had some kids, she was a single mom. She had some children and everything. And we went through it. And I got done and I said, okay, she was getting a big refund. I mean, it was thousands and thousands of dollars. It had child tax credit, had a lot of deductions and credits in there. And when I got done, she said to me, she said, I don't feel like you did a thorough job doing my tax return. And I was completely shocked when she said that. And one of the reasons why she said that is because she didn't feel like I went thorough enough in asking her questions. So the whole reason why we're going into this presentation is because some clients, they need you to go thorough. They need you to go deeper with them. And that's how they recognize value in you as a tax practitioner. So Schedule A is an area where there's mostly personal deductions, not business deductions. And sometimes asking these questions and unpeeling the onion can allow clients to actually see some value in you as a tax practitioner and also increase your retention, right? So start off with something funny. Let's kick it off here. So I want to ask you this question. Are weight loss programs tax deductible? you can go ahead and just, we're not doing any polling right now. You can just go ahead and type yes or no in the chat box. Do you believe a weight loss program? So if I go sign up at LA Fitness and I got my personal trainer and I'm working out, I'm lifting weights, can I deduct that on my actual tax return? All right, so go ahead and put a couple, some of you, go ahead and put some of those answers in the chat here. I'm gonna take a quick look at that chat and see what we can get out of that. All right, so let's go ahead and put that in the chat box. Just curious to see, do you believe that weight loss deductions are tax deductible? Anyone want to be brave and say yes or no? I'm sure we got some seasoned veteran tax professionals in the room here. All right. So apparently something must be wrong with my my little chat here, because I'm not seeing anyone post anything. Luis, if you're seeing anyone post anything, let me know.
Yeah, no, you want to open the questions tab, and we see several people
It's a
answering
question.
no, it depends, only if the physician prescribed it. Can you see that now?
Yeah, absolutely, Luis. Where would I be without Luis, technical marketing manager at Wolters Kluwer? Thank you, Luis. So absolutely, we can see definitely right here. Some people are saying yes, people are saying no. One person has the answer correct. One person has the answer 100% correct. But let's go into it. Oftentimes, these are some of the questions you want to ask clients, right? So I'm going to show you another slide here, and we've actually have compiled a list of what some of those tax deductions are. So deductible medical expenses can be something like, of course, acupuncture, birth control pills, bandages, bandage medical supplies. So you'll see on the left-hand side over here, these are the actual deductible expenses, right? So we got a list here that we compiled: eye exams, hearing aids, lab fees, things of that nature. On the right-hand side, you'll see what's not deductible. And sometimes clients may argue with you. I remember my dad, I did his taxes one time, and we had lost, my grandmother passed away, and he thought he could deduct funeral expenses. I said, no, not on this return, Dad. It's on the estate tax return. But anyway, make a long story short, so these on the right hand side, of course, maternity clothes, nutrition, I'm getting vitamins and stuff like that, that's not deductible. And you see weight loss program, you'll see it on this side that says that it's actually not deductible. But let's dig a little bit deeper, because I like what Deborah said in the chat. I definitely like what Deborah said in the chat. And I've got a more detailed list right here that I want to bring up and show you on the screen here. And this is the exact same list. And looking at this, I'm going to scroll down. But before I scroll down, I want to point out something to you. Birth control pills are tax deductible, right? Look what else are tax deductible. A vasectomy is tax deductible. So the government's going to give you a tax deduction for having less children, right? Just kidding. But you'll see right over here, definitely what Deborah said: weight loss programs for treatment specific to a disease diagnosed by a doctor. Absolutely. So that's a deductible expense. So that's why sometimes with the clients, and I can see why, going back to it 10 years later, even though that client was getting a big refund, she didn't feel like I did a thorough job, because I didn't ask her many of these questions. I took her documents, asked her a couple questions, some basic questions, and I said, hey, you're getting back a big refund. How do you want to get it? Do you want to use a bank product? So, but these types of questions you want to ask the client. So let's I'm going to unpeel the onion. I'm going to give you a practical example inside of TaxWise. We're going to use that as a good example to walk you through what it actually looks like. So I'm pulling TaxWise up on the screen, and right now we're inside of a 1040. I'm going to click on the Schedule A in TaxWise. And the Schedule A, you'll see we got medical expenses. We got all these items over here. You can walk through it. We've got real estate taxes. Now there's a Schedule A detail worksheet where we can take a look at some of these expenses. And sometimes we may leave some dollars, we may leave some deductions on the table, but also too, I want to address, in addition to that, sometimes clients may be very close to getting a medical expense deduction, and they may not have it for that particular year, but it's good to recognize maybe for next year they could be planning better for that deduction. So let's walk through this scenario I have. I've got medication at $1,930, doctor visits, these are out of pocket, these are not medical, and also ask the question, do you have medical bills that you've paid, or do you have medical bills? Now, if you got a bunch of medical bills that you haven't paid, if you didn't pay with a credit card or cash, it ain't paid, right? But, so you got to make sure you differentiate. Some clients will say, yeah, I got medical bills, but they didn't pay it. But right over here, this is the example where the client actually paid $3,030 in doctor visits. They paid $1,700 in dental visits. They got eyewear. Here's that weight loss program, right? So if the client has a particular medical condition And it's interesting, when I first got into doing taxes, I never thought about, getting into people's personal lives. But this is going to help you understand the client, because the client is going to open up to you and share some things about their personal life. It's going to help with the retention. It's going to help with that bond with the client. So you're able to get a good understanding of these deductions, also the medical mileage, right? Now, in 2021, the medical mileage was 16 cents a mile, right? I'm going to show you something in just a few seconds that changed last week. But as you can see in my example, I've got about $8,818 in medical expense deduction, right? And that definitely plays a significant part on the actual Schedule A. Now, it's not going to work with every client, but unpeeling the onion and asking these additional questions are highly important for you. All right, so let's look at this. So practice examples in Schedule A we're talking about, but look what happened on July 1st, 2022. The medical expense deduction has increased now to 22 cents per mile, right? So now let's think about this for a second. This is going to get your prescriptions, driving to the doctor's office. This is, going to a specialist. These types of things that clients are doing, and you want to think about this with your elderly clients, your clients that have some kind of disease or something like that. They've got to spend this money for medical expenses, right? So 22 cents per mile, you're getting more because, of course, the increase, inflation, gas price, and things of that nature. All right, so it's definitely something that we want to talk about. You want to unpeel the onion and go a little bit deeper with your clients. All right, so those are some of the Schedule A deductions from a medical perspective that we're going to talk about here. I want to transition in just a second and talk a little bit about forcing those itemized deductions and what that process looks like. So I'm going to bring back our TaxWise up on the screen. And looking at this in our example, we know we have the scenario where we still have the $10,000 real estate cap, right? I mean, $10,000 state and local tax deduction, right? There's still a cap on that. So you can go through the client, of course, what they paid in state and local income taxes, things of that nature. Some of you are in Florida, some of you are in Nevada, Texas. You may not have state and local. You may not have state income taxes, right? So that's going to be, you're probably taking a hit right there. But you can see that there's still some things that we can do to help be creative. For those of you that do have a state tax return, like for me, I live in the state of Georgia, right? So what happens is your itemized deductions, they flow over to your actual state return, right? So I got some mortgage interest here, $4,000. I got some gifts to charity. And one thing too, speaking of gifts to charity, you want to take some time to get a good understanding of what's going on that 8283. Oftentimes clients, they go and they give, donate clothes and furniture and things of that nature to, Salvation Army, Goodwill, and things of that nature, but they don't necessarily go and look up the value, right? Encourage your clients, go look up the value, get an understanding of what's going on, because that's money, right? That's a tax deduction. And remember what I said, the deeper you go with the client, the better the retention, the stickiness, the more results that you can have for that client. So we're looking at over here, so the client donated some household items, and we can see we got a fair market value of $600 that they've assessed from looking at the website and valuing things. And you'll see right over here that this is going to flow back over to my Schedule A. So in addition to having my medical, my state and local taxes, my mortgage interest, and then my gifts to charity, 1974, we've got a total of $19,342 that's directly on here, right? That's what we have over here. Now, for this couple, for this scenario here, we've got a couple here married, filing jointly. And of course, since the standard deduction has increased significantly over the years, let me go ahead and take that off. Since standard deduction has increased over years, a married couple filing jointly, that's $25,100, right? So, the Schedule A is kind of, there's less returns being filed with a Schedule A due to this increase in the standard deduction, right? But now you still want to take a few moments to evaluate, hey, let's look at this right here. So we can see in this case scenario that the client's getting a $3,800 refund. And where's my handy dandy calculator, right? I know some of you accountants, you got that 10 key. I went out and bought a 10 key this year so I could have on my desk, because I didn't feel like a tax professional without having my little 10 key. Makes that little sound. So I went out and bought one intentionally. But let's kind of go ahead and add this up. So 3,807, right? Plus they got a state refund of $330. So $330, right? So altogether, this client's getting a refund of $4,137. That's not bad, right? Not bad. Hey, you feel like you did a good job. You know, for those of you that do bank products, you can get your tax prep fees out of that federal refund. Not bad. But let's take a look at this for a second. We've got this $25,000, $100 standard deduction for a married couple filing jointly, but we had about $19,000 in approximately 19,000 itemized deductions. But let's force it over. When we force it over, here's that 19,342. So it looks like less. So you'll see that the federal refund went down. The federal refund was 3807. 3807. Right now, and then minus 3117. So the federal refund went down by $690, right? It went down. And let's just kind of recap for just a second, because I didn't write the number down, so I apologize. So before we had 3807, so 3807 plus 330, that equals 4137. So we're going to go ahead and write that down. 4137 is a total refund. Now, when we itemize, force the itemization of that. Let's look at the refund now. So we got $3,117 plus $1,098. State refund increased significantly. So look at that. Now the total combined refund is $4,215. Let's minus that from the previous one, $4137. So it increased by $78. But it's $78. Now, this could be helpful, right? And then of course you got to take into consideration, you know, for next year, of course, a state income tax refund, claiming it as income. If you're deducting it, you got things that you got to take into consideration. But take the extra time to run the scenario and communicate to the client the change that's taking place. Go ahead and communicate to that client that change that's actually taking place and what the scenario is running. That's value that you're transferring to the client, that you're a skilled tax professional, you know what you're doing, right? So something always take a few seconds to do that. All right, now let's move on for a second here. I'm going to come back to our PowerPoint and let's talk about the Schedule C. Right, there's some deductions that could be overlooked on the actual Schedule C. And one thing I forgot to leave out too, in addition to medical miles, back to that Schedule A, is the charitable miles driven, 14 cents a mile. Right, I forgot to leave that out there. So always ask clients if they drive for charity, any local sorority or anything like that, or any little league that's a nonprofit organization. Always want to ask your clients that. All right, now let's get into the Schedule C deductions. And now to get into Schedule C deductions, I got to do a couple things. I want to go into my Schedule C return, but there's deductions that are often overlooked, that can be overlooked by a tax professional or taxpayers. You know, determining between the mileage and the actual expense deduction. That's something that always comes up. Because, I mean, let's be honest, I've been in practice for 10 years, especially for your clients that are contractors, maybe they're painters or something like that. You know, some of them don't keep up with their mileage, right? They swipe their debit card, swipe their credit card, they buy gas, and they come at the end of the year. If you did the accounting service for them, you know, you prepared the P&L, and that's what you have for that client. But taking that extra time to coach your client and mentor them through that process of, should I take the mileage or actual expense, and what's the benefit to the actual taxpayer? Then also too, you want to take into consideration if the business usage, so if you're depreciating the vehicle, if the business use of the vehicle falls under 50%, it may trigger recapture of depreciation. So plan with your client when to use the depreciation deduction for your vehicle, right? And also get an understanding, how long do you plan on keeping this vehicle? Is your client the type of person that, you know, every 2 years or so they actually, you know, get rid of the car or something like that? Or are they somebody who, you know, keeps their truck or vehicle for, you know, 7 years, 8 years, 10 years? So those are the kind of questions you want to understand. And then also to the home office deduction. This is an area of concern when you're using home office deduction, because if you eventually sell the property, you know, the IRS can challenge and say, well, you're using that property for business usage purposes and things of that nature. So there's a lot of challenges associated with this, but determining which type of deduction method should we take, the simplified method, or should we take the actual expense method on the actual 8829? So that's something that you want to take into consideration with your actual client. So let's kind of walk through some practical examples inside of the, let's kind of walk through some practical examples of what this actually looks like. So let's talk about the actual expense versus the mileage method. So I'm gonna bring up a 1040 up on the screen, and once again, we're gonna be using TaxWise. So I've got my client here, Miss Schedule C. And Miss Schedule C, she's a hard-working lady. She's got a nice service-based business, a little bit delivery business and things of that nature. She has a nice little truck vehicle that she's using in the business. So Miss Schedule C made about $25,000 last year in gross receipts. So made about $25,000 last year in gross receipts, and she also has a W-2 where she made approximately about $50,000 on her W-2. So she's a hardworking lady, right? She's got her W-2, 50 grand, that's $50,000 she's making. And she's got her delivery business that she's working as well on the side, hardworking lady. And she made 25,000, right? So I haven't put any deductions in here yet. Let's kind of walk through some of these deductions, but gross sales of $25,000. The first thing I want to talk about is the mileage approach to this, right? So I'm going to go over to right here, the vehicle worksheet, and that's where we're going to start assembling what the mileage is. Now, if you have clients, and this is where you got to think about this too, for many clients, this is the only time in the year that that client is sitting down with a financial professional, right? You're the financial professional, right? All through the year, they're working, run their business and everything, and that one time of the year when they get their taxes done, when you do their taxes, sit down with a financial professional. So there's also an educational opportunity you could provide to the client. So when you think about this right here, I've got a little spreadsheet here, and I got this spreadsheet. You can go online and get it off the internet, go to Google or something like that, and you'll see right here, this is what you can do to create the mileage log. Pretty basic. Now with technology, there's so many apps that you can have on your smartphone. You just shake your phone and it just tracks it, your miles and everything like that. But you want to take the time with the client to educate them on this process. I remember I did this about 3-4 years ago with a client. You know, he was an electrician and he was, you know, of course, gas. And I educated him on the mileage deduction. And it worked. And now let's kind of walk through this here for a second. So let's look at this. So let's say that we've got Miss Schedule C, and let's look at this. So let's say for gasoline, right? Let's say she spent $2,500 for gasoline. Oil changes and things of that nature. Let's say about $1,200. It's a, you know, it's a nice F-150, and she had to get some stuff done to it. And then she, you know, got some tires on it as well. So this is what you're getting from the client's profit and loss statement. Her annual insurance that was spent on the vehicle, let's say $750 was for the insurance that was spent on the vehicle. Oops, I put that in the wrong place. No, insurance $750, right? And then we've got, let's see, we've got personal property tax. So we call that the birthday tax in Georgia. So you pay the sales tax in Georgia when you buy it. And then let's see, what else do we have? We got approximately just about these expenses right over here. You know, if she has a loan on the vehicle or something like that, you can definitely add that in there. Let's say she has a loan on the vehicle and she paid some interest on it. So you've got some deductions. So right now we're looking at about $6,275 in deductions, right? But you want to be able to educate your client on the value of using the mileage deduction. So when you sat down with your client and you reconstructed and went through their mileage log or went through their the trips and jobs that they did, and you were able to recalculate, reconstruct the mileage deduction or the client provided for you, you educated them on how to use it. We could say, okay, the total business miles, let's just say, you know, for the sake of time, let's just say that they had total business miles, 18,670 miles, 77 miles, right? So that's the total amount of miles they had, and then we're going to put in some sorry, that's the business miles they had. We're going to put in about some commuter miles, about 4,000 commuter miles. So for the business use of this vehicle, we can definitely see that the business miles deduction, let's come over here. So we've got total deductible is $6,275. We've got that amount over here. But then let's take into consideration the miles deduction. So we've got 18,677 miles. So I'm going to cut and paste that number. And when I cut and paste that number, total miles over there, I'm going to come over to the second page of my Schedule C. And remember, the actual expense was like $6,200, a little over $6,200. Now, look what happens when I look at the mileage method. Mileage method over here, probably, there's this, when did you play 01, 2021. All right, so we're seeing right over here, this 18,670 miles is what was driven, that 56 cents a mile. We can come back over to that Schedule C, and when we look on that Schedule C, Oops, I'm sorry, I didn't switch it over there. Let me just come right back to that vehicle worksheet. And when I come right back over here to that vehicle worksheet, we've got the 18,677. So let me pull out my calculator and let's take a good look at that on my calculator. So you'll see that we've got this 18,670 miles, 18,677 times 0.56. And that turns out to be $10,459. That's a lot. $10,459 versus the $6,275, right? So that's a big difference. You're seeing that, right? You're definitely seeing that's over $4,000, almost, yeah, over $4,000 in tax deductions that you can provide to your clients. And when you think about it, think about $4,000. So $4,000, let's just say, give or take, I'm just gonna play with some numbers here. Let's say the client happens to be in the 25% tax bracket, right? So $4,000 deduction to 25% tax bracket. That's approximately maybe about $1,000 less in taxes they're paying, give or take a few, right? This is just an approximation. But you can see how the mileage is helping the client. So maybe the client doesn't have all their mileage put together for that first year, but then as you educate them for that next year, they may have it. Now look what happened last week. Oops, let's go back. Look what happened last week. July 1st, 2022, the mileage deduction increased. Now it's 62.5 cents per mile. So for every mile the client is driving, 62.5 cents of that is deductible for business purposes. So they got to be using the vehicle for business purposes, have a mileage log, documenting what the purpose of the trip is, and things of that nature. So educating your clients, transferring that knowledge over to them is very helpful. All right. Now let's also talk a little bit more about another deduction that comes into play. The Schedule C deductions. Looking at this Schedule C deductions when it comes to the simplified method versus the actual expense method. Let's kind of go a little bit in further detail. And I'm just curious, how many of you folks would say type simplified in the chat? Anyone that uses simplified method, go ahead and put simplified. If you use the actual expense method, go ahead and put that. Just curious, put simplified or actual. Type that in the chat box. And Luis also speaks Spanish, so if you could type that in Spanish, Luis could read that as well. I'm just kidding. But go ahead. I'm just going to take a quick show of hands. Let's see how it looks for those that use simplified or use those that use the actual expense method. And we're going to differentiate between the two here. All right, I'm seeing some of those coming in here. All right, some are saying simplifies. We got some actual. Okay, that's good. That's good. So we're getting a good look at getting an understanding of who uses what. It's definitely good. All right, wonderful. So I see some coming in here. So let's kind of come over to this example here for just a second. And we're going to talk about simplified and actual expense. We're going to go ahead and talk about that. So I'm going to come out here and share my screen back out with you. And let's put TaxWise back on the screen. And we're using TaxWise because of the calculations. I just want to show you practical examples on how everything calculates and flow together. All right, so we got some good people saying simplified. I like that. Liz, you said simplified. Sandra said simplified. Wayne said always compare. And then definitely Melinda and Mike said actual, right? And Hannah said both. So let's look at this case scenario. So we're coming back. Now let's go back to Miss Schedule C. Miss Schedule C, she's got her service business and everything. So she's using her garage and she has a home office like me. My garage is literally right behind me. And I've got a little office right here. So I got a bonus room in the basement, right? So I use it as my home office where I work out of, right? So let's say that's exactly what Miss Schedule C has. She has an office in the basement that she works out of, and she has half of her garage is dedicated to her delivery business where she has various different things and so forth like that she's using in the business. So let's look at the simplified versus the actual expense method. So taking this in consideration, you'll see right over here, let's say that the total square footage of her home is 2,500 square feet. Right, average four by 2.5, right? 4-bedroom, 2.5 bath, right? 2,500 square feet. Now, let's say when she did the math, got the measuring tape, calculated it all together, she was able to determine how much is used for business. But before we do that, I want to show you something. Simplified method, for every 1 square foot, it's equivalent to $5 of a tax deduction, right? So for every square foot, it's equivalent to $5 of an actual tax deduction. That's what's actually happening with Miss Simplified. Let me get my Schedule C example over here. So that's actually what's happening over there for her. Now, let's look at this now. There's a limitation on this, right? What if she uses 900 square feet, right? It's $1,500 of tax deduction. That's pretty good, right? That's pretty good. What if she uses 1,800 square feet? Wait a second, it's still $1,500. So there's a limitation on the simplified method, right? So definitely some limitations. Now, when I recommend simplified, this is my personal opinion, not the views of Wolters Kluwer, but when a taxpayer lives in an apartment, or the taxpayer didn't really keep up with their actual expenses. So if a taxpayer lives in an apartment, it's very easy to do simplified method, because let's say that out of the apartment, let's say the apartment's 2,500 square feet, or maybe they're renting the house. Maybe they're renting the house. We can go ahead and say, okay, that she's using 550 square feet, right? So you see that limitation over there, right? You definitely see that limitation. Now, here's when you need to make a decision to go simplified or actual. Now let's take a look at this right here. So let's go back and let's say that, okay, she made 25, Miss Schedule C made $25,000, but let's take this into consideration. Maybe she had a bad year. Maybe she didn't make that much. Maybe she only did about $8,000 in sales. And now she has, oops, let's get that down a little further. Sorry, maybe she had about $3,000 in sales. So it wasn't a great year, right? It wasn't a great year for her. So her expenses exceed her income. What happened to our simplified home office deduction? It's zeroed out, right? So you can't use, it's to the extent of the profit of the business. So if the business has a profit, you could expense it down to zero, but you can't go below that. So when you find yourself in this position where a client had a loss in the business, they spent out more than what came in, they spent more than what came in, that's a good time to use the actual expense method. Or if their square footage is in excess of 300 square feet, that's another time to use the actual expense method. So I'm going to go over to the 8829, and for the sake of time, let me bring up my 8820. Oh, look at that, I didn't even add 8829. Let me go grab my 8829. So I'm just going to go hit the plus sign and bring in an 8829 into our form. And hit that plus sign, and let's add it to the Schedule C. That's correct. All right, wonderful. All right, so here's we're going to go back and use those same numbers. So the area used regularly and exclusively for the business, it's a little bit backwards over here. So we're going to say she's using 550 square feet. 2,500 square feet is what we're taking into consideration. Now, let's take a deeper dive on this. Looking at this, we can see that 22% of the home, of the expense in her home, is being used for the business. So 22% of her expenses, so 22% of her utilities, 22% of rent, 22% of mortgage interest, things of that nature, you can deduct on the 8829. Now, I want to point something out to you. See how it says excess mortgage interest, excess real estate taxes? Let's say that you have a client, and for those of you that are in California, New York, those areas that have high property taxes, or Illinois, right? Let's say Illinois. I got a friend that lives in Illinois. He complains to me every time that his property taxes is like $25,000 a year, his property taxes. So he's at the $10,000 cap. So once you cross that $10,000 cap, the excess real estate taxes, you can put that over here. So you can definitely come over here and put the excess real estate tax. So once you cross over that $10,000 threshold, you can come over here. If the client has a business and you got an 8829, what can be deducted in that Schedule A due to limitations for real estate, for state and local taxes, you can come put over here, right? So always think about that. Even when you're taking standard deduction, think about that. All right, so let's say, for instance, let's come to our example over here. Let's say that she has her home and she has well, let's say she rents the home. Let's say she rents the home and she's paying $12,000 a month in rent. In addition to that, maybe she just, maybe she's responsible for cutting the grass and some maintenance and things of that nature. So she spent about $1,500 in just maintenance. She's, part of her lease, she has to do that. Let's say her utilities come up to about, she went through her water, lights, gas, internet, because she needs internet for her business. So let's say all together that's $4,500, right? So $4,500. So all together, 22% of all these items added up, 22% of that allows her to take a tax deduction of $3,960. But wait a second, the business has a loss. So since the business has a loss, what's going to happen? Let's come down over here. You'll see you have a carryover. So that deduction is going to carry over to next year. Okay, so when a client or the business has a loss, and sometimes the client may have a loss, maybe they've got maybe they bought a truck, right? Maybe the business is profitable, but they bought a new vehicle or a new asset, and you're taking $179 in bonus depreciation or something like that. But you're taking significant deductions not being tax technical, but you're taking significant deductions that makes it on a P&L basis a loss, still do the 8829. You've got the carryover. You've got that carryover right over here. So this will carry over. So maybe next year might be more profitable. This $3,960 could help reducing the tax exposure that client's going to have. It's going to mitigate that, right? So that's a good time. Now you want to take in consideration when you're doing the 8829 that the client, is using part of their home for business purposes. So in the event that they sell their home and get that tax-free sale up to the, I think it's $500,000 or $1 million, depending if you're married, filing jointly, and things of that nature. Just let the client be concerned about that. That's an area that they could possibly be challenged by the IRS because a portion of their business being used for, portion of their home is being used for business. Just kind of, give a little explanation to that client. Now, here's I want to ask y'all a question. And this is something that comes up all the time. The question I want to talk about is how low can you go on the 8829, right? Remember that game Limbo, where you're trying to, where you go underneath, you gotta, bend your back and go underneath, and they keep bringing the bar down and bringing it down. It's like, how low can you go? And oftentimes, even myself, I'll speak for myself, with the actual, oops, I'm sorry, I didn't, somebody, Norma addressed something here and asked a question, and you're right. Let's come back to the 8829. Great point, Norma. You've got your indirect and direct expenses. So your direct expenses, like a perfect example, let's say that Miss Schedule C, let's say she bought paint for her office and she painted her office. She only painted her office. And let's say the paint and everything cost her $150. That's a direct expense. But these other items, the rent for the home, that's indirect, right? Because it's indirect because it's the entire home, right? There's some personal use of the home. So good point. Thank you, Norma. That's actually my mother-in-law's name. So thank you, Miss Norma, for stating that, for those of you that don't understand the indirect and direct side of it. So thank you. Now let's go back to having a little bit of fun. Let's go back to having fun. How low can you go, right, on the 8829? As practitioners, I believe sometimes we stop. I honestly believe that we actually stop. So let's talk about this. So let's look at the 8829, and we do a great job. And what's the square footage of your home? We just took some deductions. Now, what about depreciating your home? Now, this is a very, very touchy topic, right? There's some risk associated with it. There could be some additional taxes the clients pay later on. So you want to ask a couple questions. The IRS does allow you on Form 8829 Part 3 where the client can depreciate part of their home that's being used for business. So now if they own the home, they could depreciate it. In Miss Maximize Schedule C, she's renting the home, so there's nothing to depreciate because she doesn't own the home. But you can, and a couple questions you want to ask the client. Do you plan to sell your home in the next 2 to 3 years pretty shortly? Do you plan on putting your house up for the market? Because what happens if you depreciate the home, then what's going to happen is that you can actually have a capital gain on the sale of your home. Because let's say, so for Miss Schedule C, let's come back over here. Let's say that she did own this home. She wasn't renting, right? 22% of the home is being used for business, right, purposes. So you can actually depreciate 22% of the home down here on the 8829, right? And for time purposes, we're not going to get all too much in that detail, but that does allow you to put additional deductions. Oops, I'm gonna click right over here. That does allow you to put additional deductions in here for that client's home. So if her home was $225,000, right, you do need to subtract the land value, right? So that land value is important. Subtract the land value, right? So you'll see right over here, that portion right over here, and then you can come over here on that worksheet. Come over to my actual worksheet and that depreciation percentage. Click on that worksheet, and here's the depreciation of business home worksheet. And you can use this worksheet to determine what the deduction is for the client. You've got your method that you got to take, whether it's mid-month, that it was placed in service. Doing a little bit of research, I see that, technically it can be for business purposes, so it's not 27 and a half deduction, 27 and a half years, it's 39 years. So that's just something that you want to take into consideration, and working through the depreciation deduction over here. I'm going to just click makers right there. 1 second, and you'll see it's going to be 39 years. I just said we didn't have intent, I did it. But clicking right over there, you'll see that you can have a depreciation deduction, right? Now remember, you're going to have recapture on that depreciation. You're going to have when the client sells the home, But this is something that you want to use if that client's on the edge. Let's say the client is owing money and they plan to be in their home for a long time, and maybe they don't have the money to pay the IRS or something like that, because that self-employment tax can be really, really high. This is a good time that you can use the 8829 for depreciating the home. But just be careful, because when the client sells their home, they're not going to get that full tax-free sale on their home if it's under a certain dollar amount. This part has to be recaptured, and there may be a capital gain on it. But just make sure you have a good detailed client conversation with the client, and use it if you have to, right? All right, so that's we talked about going low, right, on the actual 8829, and we talked about it's good if the client doesn't have a profit in their Schedule C business. Do the 8829 if they've got home business use of their home as a deduction. Let it carry over and roll over to the next year. All right, so let's talk a little bit about, as we come to our final topic that we want to talk about here. On our final topic that we want to talk about is the Schedule E, right? The Schedule E, I'm telling you that many practitioners have made a good living off specializing on rental property, right? Whether it's rental property with a partnership, investment property, or rental property in the Schedule E. But many practitioners that's become their bread and butter, because there's so many clients, that own rental property, they're willing to pay for the tax advice and things of that nature. Right, so that's something they're definitely willing to pay for. Now, it looks like Jessica has a question. Jessica's saying, once the depreciation life is over in a vehicle, can we revert back to mileage? That's a good question, Jessica. I'm not 100% sure I know the answer on that. It might take a little bit of tax research to get that, Jessica. But definitely, if you want to put your email in the chat, Jessica, and Luis, he'll get that email, and we can definitely work on getting the answer for you. All right, so it's a good question, Jessica. Thank you so much for putting that in there. We appreciate you. So let's take a look at this here. So let's talk about Schedule E travel deductions. Now, I want to share something with you. If you have a client that has rental property, type rental in the chat. If you got clients together, I'm sure many of you have clients that have rental property. Just go ahead and type rental in the chat box. I'm sure that many of you have clients. Deborah has clients with rental property. Definitely Jessica, Sandra, Hannah. I mean, it's all going out there. I see all you going out there, and it's pretty common, right? Erica too, right? Where's the guys at? All the girls are responding. No guys are responding. I'm just kidding. So maybe only the women are paying attention. Just kidding. But the point I'm trying to say is that they're coming to you because you have an expertise, right, in these deductions. Now, when you're interviewing a client and you're going over their numbers, if the client doesn't have any travel expenses or deductions related to running their property, I'm going to encourage you to bring that interview, bring that discussion to a screeching halt. Stop, drop, and roll. Stop. Why? Because there's travel associated with that. What if the client has to drive to pick up rent? What if the client is driving to actually go see the property? What if the client is going to Home Depot to get some supplies? What if the client is driving to meet with a property manager? Many cases, there can be travel associated with actually using a rental property. And there's ways you can get deductions for that. So let's talk about this for a second. So I've got a couple of things. There has to be some intent, and the primary purpose of travel must be business related, right? Must be business related, right? Meals can be deductible, right? So if the client is going to Home Depot to get some flooring, maybe they got to redo some flooring or something like that, or maybe they got to get some toilets or other. I keep saying toilet. Let me stop, because I just replaced my toilet. So let's say maybe the client has to get some things from the hardware store, right? And they stop and get a bite to eat. They pick up something on the way there, right? That's deductible, right? So meals are deductible if it supports the business and business matters are discussed. Meals are 100% deductible for federal tax returns in 2021 and 2022, right? So this is the first time. So definitely now, one of the things we met with our principal tax analyst, Mark Luscombe, and one of the things he pointed out when we talked about this deduction is it doesn't have to the meal doesn't have to be consumed on the actual premises of the property, right? The meal can actually be, it can be takeout. You can go there, pick it up, things of that nature, and eat it. Maybe you're painting your rental property or something like that. but it can't be purchased at the grocery stores, not grocery store meals. No, it has to be at a restaurant, because the whole purpose of this is definitely during the pandemic, a lot of restaurants struggle. So the IRS is the U.S. government wants business owners to spend some money and help out the restaurants. That's the whole purpose behind it. So clients are required to keep records and receipts with documentation to support the travel and meals. One thing that may come into topic too, maybe you and your spouse, maybe are traveling. Maybe the client and their spouse are, doing stuff on the property together, right? But if the spouse is not that involved in it, in the business or something like that, then maybe the IRS could challenge you deducting meals for the spouse, right? So we're going to talk a bit more about that, and we're going to talk about material participation, right? So we got a few minutes left, and this is just designed to be an overview. It's not necessarily designed to go dive deep, but I want to introduce you to a topic, right? How many of you have clients? I've got a friend of mine, and I'm actually going to bring this up on the screen. Let's have a little bit of fun here before we wrap up this presentation. So I've got a friend of mine, a really, really good friend of mine, and he has some property in the southern tip of Georgia, right? So there's a property in the southern tip of Georgia. So he lives in Atlanta, right? And he has property in the southern tips of Georgia. So I think one time he was going down to Florida. Let's just say he was going to Disney World. I think he was going down to Florida for something else, on a vacation or cruise. But let's say that he's going, let's get directions here. Let's say that he's going to Disney World. So I'm going to just go ahead and put Orlando, right? So let's look at this, take a look at this for a quick second here. So he lives in Atlanta, and he is driving from Atlanta all the way to Disney World. So it hit me when he told me, yeah, I've got some rental property. He's got about a good handful of property in Valdosta, the southern tip of Georgia, right? So I said, wait a second, do you know that half of your trip can be tax deductible if you do the right things? And he said, what do you mean? And they said, okay, documentation. You've got a property manager that you use. You've got a real estate agent. You've got a lot of business activity that takes place in southern tip of Georgia. So guess what? The first part of your trip, even if you've got your family in the car and you're going to Disney World, you need to set up appointments with your property manager, your realtor. You're going to go look at a property. The first half of your trip to Disney World can be tax deductible, 228 miles. And let's kind of talk about this here for a second. So this is what's known as, before we get into that, so let's talk about that. So the first half of your trip, and then think about it. When he's coming back from Disney World, right? We can go ahead and reverse. When he's coming back from Disney World, that other part from Orlando to, let me pull this up, from Orlando to Valdosta can be tax deductible, because he just sets up another appointment, meets with the property manager, go over some properties, go over some leases, talk about eviction. Maybe he needs to go look at a property. Maybe a client, has to get maybe one of the tenants got to get a new AC unit. Maybe he wanted to meet with one of his real estate agents that is going to be selling one of his properties. So he can have a business meeting on the way back, right? So there's things that you can do to be able to deduct travel, as long as you be strategic, and you have to be intentional. So that key word is intentionality. You want to be intentional. So let's talk about being intentional for travel purposes. I'm going to introduce you to a topic, to the weekend sandwich, right? So the weekend sandwich is where clients can actually deduct travel related to their rental properties, right? So quick question, Jessica's asking, how do you document meetings? An email. You email, let's say your real estate agent is Lisa. Lisa, I'm going to be in I would like to meet with you on July 15th for a meeting to go over our properties. Can we meet at 8 a.m.? That's your documentation. You send a calendar invite, you meet, there you go. You got the notes of the meeting, what took place at the meeting. That's documentation. Email, having those things is documentation. Now let's look at this weekend, the weekend sandwich strategy here. So weekend sandwich, you got a travel day, right? So let's say for instance, Miss Schedule E over here, she has a property. She has some long distance property. Let's use my friend here for a second. So let's say he's got this property down there in South Georgia. He has a travel day. So the travel day is just traveling to it. Let's say there's also a tax conference that he's going to, right? So let's say there's a tax conference, or not tax conference, a real estate conference in Orlando. Let's switch it up a little bit. There's a real estate conference in Orlando. I want to take the kids to Disney World. It's summer vacation. How are we going to make this tax deductible? Well, the primary purpose of the trip is not to go to Disney World. The primary purpose of the trip is to go to the conference and to meet with your real estate agent and your property manager. So we're going to travel down, stop in Valdosta, meet with the property manager, go over our properties, meet with the real estate agent for a property we're trying to sell or a property we're trying to buy. Then we got a leisure day. We're going to continue the trip, go to Disney World. The kids go to Disney World, spend some time in Disney World, but then at the same time, you actually go to the real estate conference. You go to the real estate, so other work-related activities are taking place. You go to that real estate conference. So now, then you got a travel day coming back. Now this could take place with airfare. This can take place with so many ways, but you pretty much build the intent of the trip is for travel purposes only. I mean, for business purposes only. The intent of the trip is for business purposes only. You pretty much be strategic as to where the client is going with their family, and you can deduct portions of that. And you're going to work with the client as far as what's deductible. Of course, buying food for the kids, it may not be deductible unless you hire your kids in the business and things of that nature. But definitely, if you and your wife are working together, you and your spouse are working together in the business, that can be a tax deduction, right? For both of you, for your meals, your travel. The mileage is deductible. It doesn't matter if the kids are in the car, if you got an elephant in the car. The travel is deductible if you're driving down there, right? So there's things that you can do. So you want to be able to explain this weekend sandwich strategy to your clients in a way that they can maximize deductions with their client, right? So another thing is, I know we're running a little bit out of time here, but you want to talk with your clients about being active in their business, and you want to talk to them about what material participation is and those types of things with the client. So is your client active or passive in their rental business? Let's talk about that for a quick second. In a rental business, it's assumed to be passive, right? The IRS already assumed to be passive. Pretty much, you got a property, you're not working on the property to make the rent every day. I mean, you are making the repairs and stuff like that, but pretty much the client is paying the rent, and you're not working every day to build that rent, right? The client's paying the rent, so it's assumed to be passive. But maybe you are working on the property. Maybe your client is working on the property, right? Or maybe your client has a property manager and they're actively involved. So let's talk about this. So rental activity is assumed to be passive. So there are limitations on deducting passive losses against your earned income. They're known as passive activity limitations, right? PALs is what we call it. And that's the old 8582. That 8582 is pretty common. That's where your PALs, your passive activity loss limitations, where they actually add up, where they're actually stored up at. So let's kind of walk through this a little bit here, and let's go through this here. So is your client active or passive in their rental business? We're going to talk about what's material participation in a business or trade, what's active participation in rental activity, and how to properly deduct rental losses against earned income or ordinary income based on their participation in the rental business, right? So I'm going to give you this little slide here. We're not going to be able to read it, but the first thing is to determine what's material participation. You've got to meet one of these 7 tests. And one of the easiest ones to meet is being able to identify the individual participated in the activity for more than 100 hours during the tax year. So that's easy. That's, making phone calls, meeting with the property manager, talking with the real estate agent. Maybe you're interviewing, reviewing applications and things of that nature, reviewing applications for tenants and things of that nature. Clients you could easily, in 365 days or 366 days, clients can get 100 hours of of material participation in the business, right? So once you've got the client to establish that material participation in the business, the next thing that we want to make sure that we talk about is the active participation in rental business. So an individual actively participates in a rental related activity when their interest in the activity is at least 10% by the value of all interest in the activity. So make a long story short, that pretty much they participate in making management decisions or arranging for others to provide services such as repairs and things of that nature. But an individual is actively involved, where more than 10% of their income is coming for, 10% of their time is being spent involved in that rental property, right? So you got to have material participation, you got active participation. Now there's another one if the client is a real estate professional, right? And what's a real estate professional? That's not because the client is a real estate agent. All right, it's not because you put real estate professional as the occupation on the return. No, there's 2 tests that need to be met. So you've got to work through these tests with the client. Even if you don't understand all these concepts, do the research and and be able to educate the client. Because remember, the more that you can educate the client, the more the retention is going to take place. So let's talk about this. So in order to be a real estate professional, where the IRS considers you a real estate professional, more than half of the personal services performed. So pretty much, make a long story short, more than half of your income comes from real estate services, whether it's construction, leasing, management, brokerage. So you can't have a job where you're making $100,000 a year as a tax professional, and then I'm a real estate professional because I do Schedule E's. No, more than half of your income must come from construction, leasing, management, or brokerage of property, right? And where the owner materially participates. Then there's a 750-hour test that must be met, where you spend 750 hours a year in the business. And that pretty much breaks down to, so that's 750 over there, divided by, let's divide it by 12. So the client's spending 62.5 hours per month, divided by 4. The client's spending about 15 hours a week, about 15.5 hours for a week. And that's where you're deemed a real estate professional. That's where you get some of the best tax deductions for your clients. So we're going to use this example, and then we're going to go ahead and wrap up. So let's say, for instance, look at George. Your material participation test could be met with your spouse. It definitely can be met with your spouse. So looking at this, you can see right over here that, let's say George is a full-time CPA, all right? George is making 300 grand a year. He's living the dream, right? He's making 300 grand a year. He owns 8 rental properties. Him and his spouse, excuse me, let me correct that. Him and his spouse own 8 rental properties. His spouse only works managing the properties. So he's making the 300 grand a year. His wife manages the property. She's meeting with the property manager. She is reviewing the leases. She's evicting clients. She's collecting rent. She's making sure that all the repairs get done. She spends about 100 hours a month, total about 100 hours a year. In total, she spends 800 hours a year on working in this business. Now, when you factor in depreciation, mortgage interest, and everything, it comes down to about $70,000 as a deduction. So for sake of time, I'm going to ask a question. Does the spouse have income? Does George's spouse have income? Yes, George's spouse does. Because this $70,000 loss on the rental property can offset that $300,000. So because the spouse is deemed a real estate professional, this deduction could actually take place because the spouse is deemed a real estate professional. So those are the types of things that you want to take into consideration. You want to have that conversation with your clients about what the material participation is. And because of that, the client is going to pay less taxes. So definitely when you have a married couple that's actively involved in this real estate loss and things of that nature, you want to make sure you spend time with their clients. And this is one of the most litigated topics in the world of taxation. So there's a lot of articles and information on this where these deductions have been denied. So you want to make sure you spend some time with the client to go over these topics. All right. So Luis, we're going to go ahead and launch that polling question. Luis, here we're about to go ahead and wrap up here. So Luis, go ahead and launch that final polling question as we wrap up here.